Joining us now is Kathy Bostjancic. She's the chief U.S. economist at Oxford Economics. Kathy, I don't think you guys have a recession call, but you do acknowledge the risks are rising into next year. I mean, why is it when we talk about this, people go, all right, well, fine, a year from now, anything could happen. But there's a very specific reason why people are concerned this is going to end in a downturn next year.
Yeah, thanks, Kelly. Happy to be with you. It's an interesting time. Right now, there is still decent momentum in the economy, and actually, from the labor market perspective, very strong momentum. And as you highlighted, durable goods this morning showed a rebound. So business spending is still on track. Even when you adjust for inflation, it looks quite solid. But the risks do rise as we end this year going into 2023. And that's really because some of this momentum that we see in the economy starts to ease. And at that time, we think the Fed, which was mentioned quite a bit with your previous guest, gets to a more restrictive policy stance. And maybe really the Fed does hold the key here, as it many times does for the economy and also clearly for the financial markets. But they get to restrictive policy, that becomes a bit more difficult to overcome for the economy. So we're not calling for a recession, and we certainly don't have the rate increases that Deutsche Bank is talking about. I think in that scenario, you'd have to see inflation, I think, accelerating much higher, and just have to see a real protracted wage price spiral, which we don't see at this point. There's a risk, but we do think at the very least the Fed is going to have to get restrictive. Right.
Well, and that's why, saying to Carter Worth, no one wants to hear a message that says, hey, stocks don't look like they're responding well to this. But would you frame the trade-offs as the Fed can be more hawkish now, maybe more market pain right now to kind of quell the inflation problem, or we could potentially face a decade of market turbulence if everything you talk about with inflation comes to pass?
Yeah, I think that's really what the Federal Reserve is looking at. They're looking at it the prism of their mandate. So they're not specifically looking at equities as we would as investors, but they're looking at, OK, we have a dual mandate, which is to promote full employment, but with, stable prices. And right now, prices are anything but stable. They don't want that, as you say, to ebb into the medium to longer term view. So, stamping on the brakes now may be what they need to do, even if it risks a recession, to make sure that we don't get inflation expectations and wage expectations rising to a point where it's much tougher to wring that out of the system, right? Once it gets embedded to the business and consumer psyche and actual wages, much more difficult than just waiting for supply chains to resolve themselves.
Shepard Smith here. Thanks for watching CNBC on YouTube.